Today, we're here chatting about charitable giving strategies. It's a good time of year because it is Christmas right now while we're recording this. A lot of people looking at contributing to charities. We're going to chat today about some efficient ways to distribute your wealth to charities, and we might as well jump right into it. So let's chat about giving. Let's make your donations count. There are more than one way to contribute to a charity of your choice. So a lot of people contribute on a monthly basis, or maybe they just have charities come to their door asking for donations and they contribute with cash. They write a check or they contribute on a monthly basis, but there's a lot of different ways that we can do it. CRA's got some unique and preferential ways to allow for Canadians to donate. So let's discuss maybe one of the first ones.
So let's say this. We're going to talk about more of the tax strategy around it. Charitable giving is giving time, volunteering,
True.
Donating in kind, food, things like that. So we're talking about the way to move good chunks of money to charities because you desire to do so, but doing it in a very efficient manner. And giving your charity is good. So handing money out the door is not a bad thing, but sometimes it's not the best way to maximize the value of your dollar and the value of their dollar. So let's talk about the ways to donate beyond the simple contributions, beyond the way that most people think of donating. So I think the first one, if we pop the slide there, life insurance, kind of a weird one when you think about it.
True.
What's this about?
Life insurance, well, I think if we can go to the next slide, there might be
So what you do?
We've got an extra one in here on our,
okay.
So using life insurance as a donation can be relatively simple concept, but you're basically buying a life insurance policy and listing the charity as the beneficiary. So when you do that death benefit, so you do have to die in order for your charity to get the donation, but that death benefit becomes a tax deduction for your estate. So you could be sitting on a sizable estate where you're going to trigger a significant amount of tax to transition that estate to your heirs. One of the ways to reduce that tax bill would be making a charitable donation. So some people have, charities that are near and dear to them, and they want to make a sizable donation. This is one way to do it. You can contribute into an insurance policy, and then there's a very sizable chunk that goes to that charity. So that sizable chunk creates a big boost to that charity, but it's also something that's well recognized. So, if you want your name on a plaque or a bench outside the door, then that
you have to pass away.
Yeah, you have to pass away. That might be one of the ways to do it. So what's the taxable situation for somebody who's using life insurance to gift?
Well, I think you mentioned just before we hit the tax side of it, we made one comment there. Essentially, some people want to donate a chunk of money, but they're still worried about maybe their estate. They're maybe worried about their children. So they don't know how much to donate, how much percentage of their estate. Is there going to be enough of an estate left over? So just like, some of the advice we give people who have second marriages and children from a previous marriage, sometimes just buying an insurance policy, naming a beneficiary takes care of that thought. Therefore, your estate is intact. Maybe it owes tax or whatever, but that money can move on to your heirs without worrying about depleting that. That's what the insurance solves, because the insurance passes around your estate, meaning it's not part of probate, it's not part of what your will says. It's just you name a charity as a beneficiary on the policy. So I believe from taxation point of view, you can really tackle it two ways. Yep. You can have your estate get a tax benefit if you have a tax problem at death. So if it was a $300,000 donation from a life insurance policy, you get a $300,000 deduction. Well, your estate gets a $300,000 deduction in the final year in which you pass away. Yep. I believe the other way too is you can choose to make the gift at the end non-deductible, but you can deduct the premium cost of the policy. So if you're paying a few $1,000s a year and you want the tax benefit right now, then you're writing off $3,000 a year as a charitable donation versus a large $300,000 at the end. So I think my maths may be off a bit because it'd be hard pressed to pay $3,000 to get a $300,000.
Yeah, it'd be pricey if you're buying it
unless
later in life.
Unless you're 32 years old, starting a $300,000 policy for your favorite charity. Yeah. So, but I think it's one of the best ways to give. Now, charities don't want you to deal with it this way, but potentially at some point, if there's an issue and you were unable to continue to pay your premiums, a lot of times the charity will will keep the policy being paid. Now, that's not
True.
don't go out there to start a policy and pay it for 2 years and then walk away.
And say, come here, charity, and pay my premium for me.
Yeah. So essentially, I believe the owner of the policy becomes the charity. The beneficiary is the charity. You're just the insured.
Yeah.
And the payee.
Yeah. So two different ways to do deductible there.
Yep.
You can deduct get the tax deducted at time of death for the estate, or you can deduct your premiums all the way through. So both are very valuable. I think one of the other comments that you were kind of alluding to was some people may be worried that they're going to run out of money in retirement and they don't want to gift $300,000 to a charity right now because they feel like their pot might be dwindled. They don't know how long they're going to live, of course. They don't know how long they're going to need their retirement income or what kind of emergencies may arise while they're moving through retirement. So buying an insurance policy can alleviate that concern, that need, the potential need, and make sure that their charity is still going to get the donation.
And it's a great way. I mean, we can go down a pretty good rabbit hole. Insurance is a whole other discussion in a way, but you can make it joint last I, which means your premiums are way lower. So there's ways to do it. It just means between, say, you and your spouse or you and another insured individual, the insurance policy only pays to the charity when the second person passes away. So that means it's longer drawn out and your premiums could be lower. So it makes it more palatable to manage that cost, but while maximizing the gift at the end.
Yeah. And then you might get that bench put up for you.
A lot of people donate anonymously these days. I think
That's true.
Yeah.
Okay, if we can move to the next slide. Another way to donate, flow through shares. So this is one that's certainly not as common.
No. I think just so we can set the record straight on flow through shares, you can't donate a flow through share to a charity. What we're talking about is the use of a flow through prior to making a donation to a charity. So a flow through share simply is usually something to do with your resources. And basically, there's a part of the Tax Act that allows you to deduct the flow through expenses, meaning this. If someone's looking for gold or rare earth minerals, we probably should talk about rare earth minerals because that's what it's all about now.
Like a mining company.
Yeah. I mean, they're exploring. So it's an exploration credit. Well, you can explore. The only way those companies make money is eventually they hit something and then they sell that to a company who is an actual miner. So for great periods of time, all they have is expenses and no income. So in the business world, it's really hard to write off a bunch of expenses when you have no income. So what happened in the Tax Act is allows those expenses to be flowed through to the individual shareholders instead of the corporation. So what happens is when you put money into flow through, it acts almost in a way like an RSP would be. You put money in and you get a tax write-off pretty close equivalent to the amount of money you put in. There's some other math that's done there, and it's a little bit funkier. And probably if you're going to do a flow through, you should have a CPA managing your taxation because these things can last multiple years from additions, subtractions, and things of that nature. So once you do a flow through, there's some very short-term type flow throughs that used to be they take a few years. Now they're flipping over every year. So you put your money in 1 year, you get the write-off for the flow-through. What happens when the flow-through matures is they tend to roll the money into kind of a mutual fund or a mutual fund trust, or they return the money to you of whatever's left over from the value of that flow-through. And that's the point at which you make a donation.
Okay. So you get a credit for purchasing the flow-through initially,
right?
Which is a tax-deductible credit. And then when it matures, you get whatever cash is left. So there could be losses on that. You put $10,000 in, maybe you get $7,000 back. But you got a credit for the $10,000 you put in.
Right.
Okay, so now you've got $7,000 back in your pocket, and you're using that for a charitable contribution?
Right. So it can either be $7,000 is back in your pocket, or $7,000 is they rolled it over to maybe a specific mutual fund that their firm runs, or an investment. It could be just the share itself. So what happens then is you can make an in-kind donation. So some charities are set up for this, usually the bigger ones, in which you donate the security itself. So by doing so, you dodge the owing tax on the capital gains of that donation. So that's a whole other way of donating, and we should probably touch on that one at some point here too. But so effectively, in your example now, it's on a flow through. We're not going to say you put in $10,000 and it's worth $10,000 and you donate $10,000. We know that they tend to come in a lower value. So let's say you put in 10 to the flow through, you write off $10,000 that year against your taxes. When it matures, you take the $7,000 or $7,500 or whatever the value is at that point, and you donate either that as cash or in kind, and you get a $7,500 charitable receipt.
Gotcha.
So effectively, you have $17,500 of deductions to donate $7,500. So in reality, every province is different, but think of it this way. It's kind of like the cost to you out of pocket to make this donation was $4,000, but $7,500 ended up in the charity's pocket. So it's pretty significant.
Right, because of the initial credit that you got on your $10,000 contribution to the flow-through share is a credit because that's a mining company or exploration company, so you get that tax credit immediately. And that's what makes your out of cost, your cost out of pocket, your shrink. Yeah. And you end up being able to donate more than your true cost. Yeah,
and I mean, it's probably important for us to say this, in investing in any flow-through, $10,000 in any given year can be zero at the end of the year. And it could be maybe $11,000, maybe $12,000. So there is extreme volatility in flow-through shares, and it's not for the faint of heart, and it's not for everybody. This is just an example of what could potentially be done.
True.
There. Yeah.
Okay, flow-through shares. So let's jump to our next slide.
I think we just have the little bit of the
we had a bit of
the flow.
A flow on a flow-through share. How this process works.
Here, let's roll through this quickly. So as we said, you put the money in the flow-through, you get your first tax deduction. And then you donate your proceeds and you get your second tax deduction. So in this case, this is an example of using a foundation. So the money gets donated to a foundation and then they do the administration, the donation to your particular charity. So when you go from 2 to 3, that's when you get the donation receipt, and potentially 3 is now paying out to the charities as a grant from a foundation. So that's one of the ways to do it. So there's a lot of different ways to do this with the flow through, moving through the process. So we'll get past that. We'll get into an even more difficult one.
Yeah, no doubt. The next one for contributions is establishing a charitable remainder trust. So I got a number of bullet points here that shows the steps that you would take in order to establish something like this. But essentially, you're putting your money, your principal, into a trust where the beneficiary of the trust is your charity, your chosen charity.
Right.
I guess what people have to keep in mind is that by putting money into that trust and getting a deduction for doing so, that money is locked up in there. It's gone forever. You cannot get that money back out. You can, however, continue to live off of the interest or the growth that trust derives, or what it creates in terms of its investment.
It's very much like a testamentary trust at death or a spousal trust, where you might have a spouse and you might have children, and the spouse lives off the income and the children get the capital when the spouse passes away. So in this case, you're the spouse, you're living off the income of the charitable remainder trust, and the capital in this case goes to the charity at the end. So it's a little bit like a foundation, but just you think of a foundation, somebody doesn't start a personal foundation unless they have millions of dollars to do so. Whereas a charitable remainder trust would allow someone with a smaller capacity to do so. I've got to say, after 20-something years, I think I've only seen one of these.
Yeah,
it seems to be difficult. And as we talked, the downside, the trust needs to file a tax return every year, and it's not your personal tax return. It has its own trust. I think it's a T3 return. What is it? T1 is personal, T2 is corporation, T3 is a trust.
Okay.
We're not accountants, but we know enough to be dangerous. So,
yeah, that is a downside. So an added administrative expense to your household to file that trust every year. Yeah. But it does get you the immediate tax credit or the immediate credit for contributing to the charity, a lump sum, and gives you the flexibility to still live off of the growth or the interest and gains that investment can make. So in our earlier conversation, your points was talking about not wanting to give away a lump sum yet and buying an insurance policy instead because you're concerned about having access to cash flow.
Right.
So this is one way to say, okay, well, I'm pretty sure I'm not going to need my lump sum. I'm instead going to just be comfortable living with the growth that it produces, and I'm going to donate my lump sum right now and get my tax credit. So that's really what the charitable trust is.
Almost a reverse way. Just to manage cash flow and manage donation expectations.
Yep. Great.
I think we can probably talk about what is best. Obviously, the easier the better sometimes, but it does not necessarily mean the best end result. Now, we always seem to get into this when we talk about donations and charities and things that just give the money and don't worry about it, and that's kind of the mandate. But there is some tax strategizing around this. There's a reason why there's a tax credit. It's because as Canadians, we want people to donate money, and we're willing to give you a deduction for it, which means there's some planning that can be done around. And it's not wrong to do some planning to line up your charitable side of your world with your personal financial side of the world. It makes sense. So I think we touched on it, and we probably should maybe even have a little comment down this as donating shares in kind. That's probably a big one too. The example on this would be somebody's bought either a mutual fund or a stock. Let's say this is non-registered money, $100,000, and it's worth $200,000. If they were to sell that investment, they would incur a $100,000 capital gain and have to pay. They get $50,000 of that back tax-free, and they'd have to pay tax, kind of like a T4 income on $50,000, that kind of tax rate. So sometimes people realize, you know what, I don't really need the $200,000. I want to use it for a charity. So instead of giving $200,000 and coming up with it from some other source, they give and donate their shares in kind. So they donate $200,000 in kind, but it has a $100,000 capital gain. If you do that, the capital gain goes poof. You don't have tax on the $100,000, but you do get a $200,000 tax deduction. So it's very significant when you have a massive capital gain to donate it away.
And no gain for the charity to absorb either. That gain is
other
like
than the straight
poof.
money. Yeah.
Yeah.
So that's the other encouraging way to donate in-kind shares, stocks, bonds, things of that nature. So it's a great one.
And you make a good comment. There should be planning around your charitable giving. I mean, it either enhances what can be done for the charity or it enhances what's in your pocketbook. And if your pocketbook is enhanced, then your ability to be more charitable is enhanced. So
exactly.
Doing some planning around your giving is a good thing.
Yep.
So that's the major points that we have today. Thanks very much for watching this episode of the Tower Wealth Advisory podcast series. If you want to find more about us, go to towerwealth.com or follow us on social media.